You can also explore more information using the icons on the bottom right of your screen. uh, with that, now let me introduce you to our corporate presenters. With us today are Mr. Robert McKee, CEO of Firm Capital Property Trust, and Mr. Sandy Poklar, CFO of the REIT. With that, I'm going to let Bob walk us through his presentation.
Thanks so much, Yash. Thanks for joining us today. My name is Bob McKee. I'm President and CEO of Firm Capital Property Trust, and with me is Sandy Poklar, the Chief Financial Officer of the trust. Capital preservation through disciplined investing is a key philosophy deeply ingrained throughout the firm capital culture. It allows us to deploy capital to the best opportunities across different sectors that meet our investment criteria. This means we don't specifically target assets or geography, but look where the best opportunity lies and allocate our capital into those areas. Firm Capital has over a 30-year track record of success across the real estate capital stack and operational expertise that allows us to make attractive returns for our investors without taking unnecessary risk. We have a highly experienced team of real estate professionals across our debt, equity, asset management, property management platforms, and this knowledge base allows us to maximize our returns while protecting capital. As well, our corporate governance is enhanced by the participation of our directors and trustees in both direct investing in the underlying assets, as well as participating as investors in our public entity. The trust holds a diversified portfolio of real estate that generates an attractive monthly distribution for investors with a payout ratio of 103% for the year ended December 31st. On an adjusted basis, as a result of CECRA bad debts, the payout ratio would have been 99% for 2020. We have worked hard to increase our average daily trading volume over the past several years and have been able to get to an average of 18,000 units a month for the past 12 months. The trust currently has a conservative balance sheet with a low leverage ratio of 51.7%, and our investors have benefited through the growth, both of an increase in our net asset value and through our consistent distribution increases. To date, we have increased our annual distribution 8 times, from an initial 35 cents per unit to a current 51 cents per unit on an annualized basis. Our 2020 distributions qualified as a 100% return of capital. However, given our capital recycling program, we expect our distributions to have a portion of capital gains this year due to the gains on asset sales that we have completed to date or are pending. Finally, the trust has capacity for growth through our revolving credit facility and through our retail asset recycling program without the need to access the public markets to fund our current growth plans. We believe that the trust provides a compelling investment opportunity for investors, and the unit price has currently returned to pre-COVID-19 levels. We are currently focused from an asset basis of increasing our exposure to multifamily and industrial assets and divesting some of our non-grocery anchored retail properties. We've started the non-grocery anchored program. We've completed 4 sales to date, and there are approximately 5 additional sales of non-grocery anchored properties that are at various stages of completion right now. The portfolio is diversified predominantly between grocery-anchored convenience retail and industrial assets. While we are diversified geographically, we are currently predominantly focused in Ontario and Quebec. We expect to see a reduction in our non-grocery anchored retail portfolio and an increase in our multifamily and industrial asset allocations by the end of Q2. We have a strong tenant base with high quality national tenants comprising almost 30% of our NOI. I'll turn it over to Sandy, who will now take you through the next few slides.
Thank you, Bob. So slide 11 talks about our disciplined equity strategy. And as you can see from the chart, we illustrate all of our various equity raises that we've completed since our IPO back in November of 2012. We've completed 12 equity raises since 2012. And as you can see from the chart, we've continuously and disciplined on a disciplined approach raised equity at progressively higher equity prices. We believe that it's our internal philosophy never to do down rounds, i.e. raise equity at lower prices lower than we did the previous equity raises for the sake of raising equity. Rather, we continuously try to issue equity at higher prices so as to not dilute our previous unit holders who've come in. Furthermore, all of our equity raises have been accretive to our cash flows and have been non-dilutive to our NAV over time. On slide 12 is a bit more about our total return on our investments. As you can see, since our IPO back in 2012, if you invested $100 today in Firm Capital Property Trust stock, it'd be worth $221, which is a 10.4% compounded annual growth rate over that same period, and that assumes dividend reinvestment. Slide 13 is more about our portfolio growth, and it's been, as you can see, we've steadily increased the size of our portfolio over time. To date, we're sitting at around just under $500 million of assets, which equates to a 42% compounded annual growth rate, again, since our IPO in 2012. Because we have a lot of joint venture investments, including our joint ventures, we currently manage internally here about $750 million of assets for just the property trust, including our joint venture interests. Slide 14 is more about our distributions. This is a great graphic in that we're the only REIT in the Canadian landscape that has raised distributions 8 times in 8 years, which represents just under a 5% compounded annual growth rate. It's our philosophy to reward investors annually with the increased distributions, similar to what we do with Firm Capital Mortgage Investment Corporation, in that we distribute all of our cash flow annually. Furthermore, our distributions for the past 2 years, on average, have averaged just under 100% return on capital. So again, a very highly efficient tax efficient distribution. Slide 15 is more about our NAV growth, or net asset value growth. And as you can see from the chart, we've progressively increased NAV over time, which speaks to our ability to acquire assets accretively, as well as at prices that are at discounts to where they should be trading at. Furthermore, our stock today currently trades at a 15% discount to NAV, which represents a great risk and reward return for investors. Slide 16 is more about our Q4 financial highlights. And as you can tell from the chart, we've been consistent on our key metrics: AFFO per unit, NAV, but more importantly, we've increased NAV, from quarter over quarter to $7.61. So again, a great outcome for us historically over time. On that note, I'll turn it over to Bob, who will continue on with the rest of the presentation.
So from an acquisition standpoint, we've been very selective in our acquisition program and really ensuring that they meet our criteria, and we're not growing just for the sake to create scale or to earn asset management fees. So, through 2020, we really sat on the sidelines and didn't make any investments after the March 18th closing, and that that deal was firm in January before COVID hit. And this year we're back in the market. We just completed our first acquisition. We did a 50-50 joint venture with an entity that's aligned with management and the trustees in a manufactured housing community within the city limits of Calgary. We have a separate fund that's co-investing side by side with us on the manufactured housing community, and we're looking to make more acquisitions in that sector and grow that as part of our multi-residential portfolio. From an outlook perspective, moving forward, I think it's really difficult to fully evaluate the impact of COVID. Until we really see that the government grants and all these incentives have stopped, it's going to be difficult to judge which tenants are going to come out of this in a strong position. We expect that we'll probably continue to see a few more bankruptcies in our portfolio than we would have normally, but for now we're not seeing that. We have a property in Mount Royal, which is 160,000 square foot single tenant industrial building. That's currently leased to Le Chateau. We expect to get that back probably in late Q2 as part of their CCAA proceedings. But we're expecting that we should see between 30 to 50% increase in rental rates as the asset was leased substantially below market rates when we acquired it. So we really view that as an opportunity. And I think if we had control of the asset and we could replace them, we've already had several interested parties. We just can't give them certainty on timing right now. So that's been the impediment to getting that released. During Q4, we collected approximately 96% of our gross rents, which is which we would expect to be in line with a typical collection for a quarter. We've seen an improvement in the leasing market with increasingly strong demand for industrial space, with significant increases in rental rates both on new deals and renewals. So our Montreal and Waterloo industrial portfolios, we're seeing really strong rent increases. Alberta, we're predominantly seeing flat to our expected underwriting values for new deals for the two portfolios we acquired there in 2020 and 2019. Retail as a whole has remained relatively flatter than the industrial market, and our multifamily portfolios have performed well. We also expect to see that interest rates will likely remain low into 2022, especially at the shorter end of the yield curve. We'll probably start to see earlier increases in the longer term bonds. So we think that there's still a good opportunity to do attractive term debt deals. That said, we really have no debt maturities for the balance of 2021. We have one small mortgage that we're paying out in April. On our NCIB program, we purchased back approximately just under 1.3 million units at an average price of $4.84, and that had a significant impact on both our cash flows and also increased our net asset value per unit. So we were happy with the result of our NCIB program that we implemented last year when prices pulled way back. Obviously, we've announced our 8th consecutive distribution increase, which commenced in 2021. So that's something we always look to see if we can increase our distribution, and obviously that's going to depend on our acquisitions and the performance of our assets over the remainder of the year. So, we typically start to view that in September, October timeframe. And then I think, finally, we expect to grow predominantly through acquisitions during 2021 with a focus on the residential sector and the industrial sector. Probably won't buy industrial in Toronto. We just don't see the value proposition for a cash flow oriented REIT to be making those investments in that market. But we do see attractive opportunities in other large markets across Canada. With that, I will turn over the presentation to any investor questions.
All right, Mishta, are there any questions from investors?
No questions yet.
Okay. In the meantime, if I could get a few questions. So, Bob, recently you acquired a manufactured home community in Alberta, a new asset class for you guys. Maybe you could explain your rationale behind that and your plan going forward.
Well, I think Firm Capital has owned, not in the property trust, but privately, they've owned 3 Ontario manufactured housing communities for over 20 years, and they've always looked to grow. We've had somebody, Leslie DeDouche, recently joined the entity from Canaccord and wanted to expand and grow the manufactured housing portfolio as a business area that he was interested in. And so we created a separate LP. We brought in some external investors as well as trustees and management into that structure. And we're going out and making acquisitions in that the manufactured housing community space, and we're going to grow that platform over the course of the next few years.
So we should see more acquisitions from the trust perspective?
Yes.
Okay. And what about the apartment asset class? Would you be growing in that?
We're definitely looking to expand that, and we should have something that we'll be able to disclose in the short term. But we are in due diligence right now on a couple of transactions, and we expect that we will be able to announce those shortly.
Okay. And how are you positioning yourself if this pandemic continues for the rest of 2021? Are you worried? Are you excited? What opportunities or risks are you seeing on the horizon?
I think we're worried obviously about the length and the amount of shutdowns that we're seeing, because we're not certain that they're achieving any purpose with them, and they don't seem to be shut. If you're going to shut down everything. Shutting down this and leaving other businesses open really makes no sense, and they end up impacting businesses for a long period of time. I think the government is doing a reasonable job of funding these opportunities, but I think we need to watch these companies. I mean, a lot of them are going to be hurting. Fortunately for us, we have very few tenants that were shut down for extended periods of time. We only have a couple of sit down dining establishments. Most of ours tend to be fast food that have remained open for takeout throughout. So we haven't been overly affected by this. On the opportunity side, we've seen where we have lost tenants. We've actually been able to replace every single tenant we've lost throughout the pandemic with higher rates, even within our retail portfolio. We haven't had to do a down rental rate deal for a new tenant replacing a tenant that left due to COVID. But overall, we've seen very small losses. So I think Paul Bloom was asking a question about the trading volume, and it's 18,000 units per day is the average trading volume, not monthly. So it would be about 350,000 roughly a month.
If there are no more questions, I have one more question about your retail exposure. I know you are mainly in the grocery anchored retail sector, but are you thinking about making any changes to that strategy? Anything there would be great.
I think we've been happy with the performance of our grocery anchored retail. Most of the tenants have been performing, with a few exceptions. Maybe defaults in that are twice as likely to twice as frequent as they were prior, but I don't see any significant risk there. And most of the large grocery stores are now paying less gross rent than they would be in industrial spaces in most of these retail locations. So the industrial market has gone so far ahead of these large grocery stores that they're not leaving you for industrial locations.
Given this rent differential or the gap, do you think we might see some malls converting to industrial space?
I don't know if they're really suited for industrial. They don't have the right characteristics with shipping and such. So I'm not expecting to see a lot of that transpiring.
All right. How do you see and this is more like a broad question about the Canadian retail landscape. What is your expectation about the retail sector in general over the next 3 to 5 years? Where do you think we will end up after the pandemic is over and the dust settles down?
That's difficult because you don't know how each individual business is going to be affected by the different attributes that are going to come out of this. Maybe we go into the same type of euphoria that followed the Spanish flu, and we have like another roaring 20s. That could be a potential outcome. I don't see it as the portfolio that we have on the retail side is very convenience oriented. It's not something that's easily replaced by e-commerce. So a lot of our we have very little fashion. Most of the tenants that we have in our retail portfolio are not things that can be displaced easily by e-commerce. And even if you look at the food delivery services, they still need those local points or small restaurants to be producing product for them to deliver. You can't mass produce the food in a large industrial warehouse and get it delivered out quickly to local consumers. So I think you're going to continue to see that you need retail, especially on the convenience side. We've avoided that fashion, electronics, anything that really can be marginalized by e-commerce. We've really avoided the retail types of properties that have that as an attribute. So I think we're comfortable with our portfolio and how it will perform over the next 3 to 5 years and beyond.
Okay, that's all I had for this management team. Nishita, are there any other questions?
No, Yash, there are no more questions from the attendees.
Okay, then with that, this session has come to an end. If management would like to share any additional remarks, they can go ahead, or otherwise we'll end this session here.
Just thanks so much for including us. It was great to be given the opportunity to participate. Thanks so much, Ash.
Okay,
Thank you, Ash.
thank you. REIT panel discussion at 10 o'clock. On the panel, we will chat with CEOs of Fronsac REIT, Pro REIT, and PTB REIT. We hope you can join us there.